The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. And now, it's time to break down the options market. It's time for the Option Block. With your hosts, Mark Longo from theoptionsinsider.com, Mark Sebastian from OptionPit.com, Mike Tusoff from KnowYourOptionsInc.com, and John Griegas from Options Express.
Welcome back to the Options Insider Radio Network and our series of sneak previews of our latest show, The Option Block. And we have a lot of interesting material to get to, so we're going to dive right into the trading block.
The trading block.
All right, welcome to the trading block. This is the segment where we break down some of the interesting market activity we're seeing right now. And today is another day where the market is pretty much on some fairly conflicting news. We saw jobless claims were up, which is, generally a bearish sign for the market. But at the same time, we also had new home sales up about 7.5% last month. So these two things seem to primarily cancel each other out in a macro sense. We're not really seeing much. We saw a bit of a rally and a bit of a sell-off. What are you guys seeing out there?
What I'm seeing is a market that isn't exactly sure what it wants to do. All right, we've had kind of a run up from about 11.05 all the way up to, we got up to 11.45 ish. We might have even touched 11.50. Let me check here. And now we've come kind of back down to earth. We're at 11.25. You know what we did not touch? We got the high. The absolute high was 11.48.59. So we rallied, relatively quickly in the SPX, about 40 points in, 1, 2, 3 days. And, at the same time, implied volatility was kind of rising with it. And then, to make matters worse, in 14 days, the NDX, the NASDAQ 100, do you know how much it rallied? You guys... 10%. 10%. That is an unbelievable move for where the volatility levels were set, where they were trading. They were trading at about a 20% 14 days ago, and we rally 10%. I mean, it's just unbelievably high realized volatility relative to what the market was pricing. And so, needless to say, we actually slowed down, and now vols are starting to creep up, which makes me think, okay, we may be heading for some type of cyclical downward movement. We're in this range where we're going to about 11.30, then down to the 10.40. Then we went up to almost 11.50. Now we may drop to 10.50, 10.60, 10.70, and then maybe we'll pop back up. But I certainly feel like we may have had kind of a temporary top out right here. I obviously could be wrong, but that's the way it just kind of looks to me right now. Mike, what do you think?
Well, I think we've had quite the bull run. There's no doubt about it. And the question becomes, was today just a minor pullback, or could this be a possible reversal? Now, the other thing to kind of add to what you're saying, do you think that the fact that we're staring October in the face could also be another bearish sign in the marketplace, even with this huge rally that we've had?
Mm-hmm. Yeah, the October jitters may be creeping into the marketplace here. Everyone everyone's a little unsettled by these levels. Even back when we were lower, people were unsettled at the levels. Now that we've rallied a bit, I don't think anyone's too sure of the market's footing right now, particularly when we're staring October in the face.
Well, it's interesting. On Monday, we were talking about the fact that I was noticing that the time spread was way out of whack. Do you guys remember that? And since Monday, Tuesday, Wednesday, Thursday, the time spread has gone from over 2 points wide between October and November to closer to about 1.5 points, maybe even about a point. So we've actually seen October vol itself rise. We've seen an uptick in November, but not at the same clip that we're seeing in October. So to me, it sounds like people are starting to think we're going to actually get some movement. The guys that have been coming in and just unloading that front month premium just don't seem to be doing it right now. Okay? Things got low enough, and it looks like we may be heading back toward, front month volatility above 25. That's just kind of what I'm seeing right now.
The Odd Block.
Welcome now to the Odd Block, and this is the segment of the show where we discuss some of the interesting and unusual options activity that we've seen over the past few sessions. And we've been off for a couple of days, so we've missed a couple. So we'll just catch up on a couple right now, starting with Southwest Energy. This one closed around $32.30, $32.40 today. This is an oil and gas company out of Texas, and they're usually a pretty light volume name, but yesterday they put up about 7 times their average daily volume, most of it in one very large spread. We had a trader come in and buying 10,000 of the Jan 32 calls for $2.80. He sold 15,000 Jan 36 calls for $1.13. So he put on that spread 1 by 1.5. And then to finance it, he turned around and sold 15,000 of the Jan 29 puts for $1.30. So you can look at it a couple different ways. You can look at it, but primarily he did this 1 by 1.5 call spread, and then he used the put spread sale or the put sale to finance it. And this guy has got to be pretty bullish because this is a very heavy bullish trade. Either the stock's got to rally up to about 36 for him to start praying off, or on the flip side, if this thing starts dropping, he's long a sizable amount of SWN down at the 29 level. So this guy obviously thinks that Southwest Energy is moving north before Jan expiration. I'm not sure if any of you guys had a chance to look this one over, but it was
I'm looking it over, and it looks like I would tend to agree with you that the guy's making a bet that this thing is going up, but I feel like based on what he did, he's a lot more confident in it not going down than he is on it really, really rallying quickly. It feels like this guy thinks it's going to go up, but he's just not sure when, because that's the only reason why he would set this thing up the way he did, where with zero cost. The trade he put on was a clearly bullish trade that he financed left and right, and that way he doesn't have kind of the decay problems that he would have had just owning the 32 calls outright, or even owning the 32-36 call 1 by 1.5. So by my best estimate, the guy is certain that it's not going down, in his mind, but he's not 100% certain at least when this stock is actually going to rally, but he thinks it's going to at some point.
Yeah, that's a good point to bring in, this discussion a bit of the gamma and decay side of this spread, because obviously this guy didn't want to sit there and pay through the nose for this spread, right. Not just in outright premium, but also in decay over time. And so that financing sale of the put actually comes in a couple different ways. It kind of cleans up his gamma a little bit, cleans up his decay. And so he's not as desperate for an immediate upside bullish move now that he's got that financing leg of the trade on.
Exactly.
Yeah, and that's one to where, like, with that, to add to that a little bit, it's one to where even if it does go down a little bit, he still has a little bit of breathing room down to 29 to where he doesn't have to have his finger on the mouse pad, so to speak, as he's watching it. So he did leave himself a little bit of downside room with the financing that he provided.
That's true.
Moving on now to the next victim, which is Computer Associates, CA, and they closed around 2080 today. And they are another one that saw some interesting activity in yesterday's session. They had a pretty sizable gap up in bearish put activity. Their options volume hit about 7.5 times their average daily volume, about 17,000 puts and 4,000 calls traded, so people were heavy on the puts. And the bulk of those were in the Feb 19s and 20s, so these were still near at the money, out of the money puts. With about 4,000 and nearly 9,000 traded on those respectively. The bulk of those on the ask, so a bunch of these guys are coming in buying. What's interesting about this is there really wasn't any particularly interesting news or developments in CA that would explain the sudden uptick in bearish activity out there. So some people could be looking at earnings. Other than that, there wasn't much else going on out there that would warrant a substantial uptick, unless people think the stock's just due for a near-term pullback.
I don't know. It's weird because I'm looking at today's volume, and we had a customer come in and buy about 5,000 of the Feb 22 calls, and a customer bought about 8,500 of the Jan 2012 calls, 2012 25 calls, both kind of long-term bullish plays.
Yeah, so I guess someone else is coming in saying, no, you're wrong. I'm taking the other side of that.
Yeah, you'll see that all the time. And it could be a thing where, they think the volatility in itself is just cheap and they think it's going to go up. It could be two firms banging computers. We used to joke that Chicago Trading Corp and Citadel used to have at it, but instead of swords, they would use their tablet computers to fight each other. And it certainly could be just two people with opposing views putting on opposing trades, or have one of these guys put on kind of a long-term trade, and the other one was more of a shorter-term trade. So it just could be one guy's a long-term bull and another guy is more of a shorter-term bear. It certainly could be that.
Yeah, 'cause the only thing that I'm seeing, like on this chart, the only thing that I'm seeing from the standpoint of the stock itself, technically speaking, it's tinkering up around the 200-day moving average, but it kind of just looks like the market in general. It's been going up so much in the month of September. It's up from $18, but now it's getting ready to touch the 200-day. Maybe that's what the bearish trader was seeing.
Yeah, I mean, vol in this product is still relatively low as to where it's been over the last 3 months, over the last 6 months, and low relative to where it's been over the last year and 2 years. I right now the 30-day out vol is right around 30%. that's I would certainly not call that like bottom rung low, but it's probably more toward the low end of, especially over the last 6 months.
Then moving on to what we saw yesterday, at least in the VIX, and we have some interesting stuff from today too, but yesterday was one of the ones we want to focus on because we only tape a couple times a week, so we want to fill in some of the gaps. The VIX saw some interesting call rolling yesterday. One guy came in with some sizable call rolling, and he bought 23,000 OCK 24 26 call spreads. He paid 60 cents for those, plus 8,000 of the OCK 25 27 half call spreads for 57.5 cents. The same guy also came in and sold 23,000 of the Jan 25 27 half call spreads for $1.32, and then sold 23,000 of the Feb 25 27 call spreads for $1.32 as well. And so this guy essentially is rolling his call spreads from October out to January and February, and extending. Obviously, he's extending his short vol bet for out through Jan, February, that the VIX is going to stay below the mid-20s for the foreseeable future. Pretty busy day for VIX yesterday with 237,000 calls and 141,000 puts changing hands, which is substantially more than the norm for what's going on out there. And I know, Mark, you like to watch VIX on a regular basis. What did you make of this call rolling activity as well as what we saw today?
It's interesting. I saw that yesterday, and someone said, why would somebody buy that with the VIX trading at 22.5? It really has to move. The VIX futures the guys already made a bunch of dough off of the movement in the VIX futures. Yesterday, if you bought the 24-26 call spread, the 24 call was the at the money call. So right now VIX October is trading about 25.80. It's up, it was up 85 cents today, with the Nove trading. I'm just looking here. You have to find, it's really hard to find these quotes. The Nove trading about 28. So we're seeing some guys really thinking that we're going to see some rallying here. And VIX futures are certainly come off their low. I think when we talked on Monday, they were trading around 24.20, and they move much slower than the VIX cash. They move much more at a measured pace. They're like the Fed. They move at a measured pace. And for them for the VIX futures to be up 85 cents today is a pretty big move. They're a far more forward-looking contract than VIX cash or VXX or some of those other ones. So yeah, this guy, the front month guy was making a bet, and then I guess long term he thinks it's going down. It's an interesting gamma play. He wants to get long gamma, but only thinks it's going so far, so doesn't want to pay for a ton of it. And then he wants to get short Vega, but wants to protect himself from a kind of a blow up, so he puts on of course, opposite call spreads.
Yeah, he had it on for ACH and decided, I guess, that wasn't long term enough for his viewpoint, so he rolled it out to Jan Feb. And here we are also with like to throw in some interesting little names as well, because these are always some interesting hot spots for unusual activity. And today, actually, we saw some interesting trading going on in Avenir Pharmaceuticals. I'm assuming I'm pronouncing that right. I've never really watched this one before. It's AVNR, closed today about almost $3 exactly. And this is a smaller name. They trade about 1,400 contracts a day, but today they put up over 17,000. So you're talking well over a 12 times increase in the average daily volume. And we saw the bulk of that, in fact, all of that pretty much was in one sizable trade where we saw one trader come in and buy 2,000 of the March 5 puts, so in the money puts, for $3.10. Then he bought 4,500 of the March 2.5 puts for $1.20. So he did that 1 by 2.5, but both legs were long. At the same time, he also bought 2,500 of the Nove 5 calls for 55 cents. And he bought 5,000 of the Nove 2.5 puts for between 75 and 80 cents. So he really mixed it up on this one. He looked like most of this looked like it was he's looking at some substantially bearish activity, except for that chunk of Nove 5 calls he threw in there for 55 cents. This is a fun one to piece together. It's kind of like putting together a little bit of a jigsaw puzzle. And, this guy, he could have a number of different axes to grind in this name. Could have a size amount of underlying that he's sitting on and he wants to hedge a lot of it. He could really think vol is moving. He obviously thinks near term this stock is going probably south from here. And either he wants to hedge his underlying or he wants to take a sizable bet on some downside movement. And at the same time, he wanted to also extend that play out to Nove, pretty much a strangle on out there in the Nove area, where he's thinking this is going to go beyond the 5 strike and below the 2.5 strike by Nove as well. So 2 interesting trades in multiple months in the exact same underlying, all for well beyond the volume we normally see in this little name like AVNR.
So he was selling the 2.5 puts in March. Or would he buy those?
Or he bought them. He bought everything pretty much.
You know what I think he might have going on is he might be a big stockholder.
That's what I was thinking as well. That's the only real axe to grind I can really see on this. Is this guy's got a ton of underlying.
He's got a ton of underlying, and he wants more of it if this thing catches a rally. But he wants protection on the downside. That would make a lot of sense to me, because all he's done is put on all sorts of. The March 5 puts that are in the money, all those are calls. Okay. Well, I don't know why he wanted all that premium. A little weird, if you ask me.
Exactly. This is not the way I would have structured this if I was this guy.
Well, you never know. He must have had his reasons to do things. But he's got, and it could be he's an insider that needs to have certain types of trades on in order to hedge these type of things. Like, you never know exactly what the customer is up to. But the best I can figure is this guy owns a ton of this. It's definitely caught a run up. If you look at a chart of this thing, a year ago this is trading $1.80. 6 months ago it's $1.75, and then it gets a pop up, and it sounds silly, but jump from 180 all the way up to $3, $1.20. Well, the thing you have to remember is that these inexpensive companies, when they're low on cash, do you know how they pay off their employees? They grant them a ton of stock and a ton of stock options. Yes, it totally dilutes the company. That's actually why half of the penny stocks are penny stocks, because they just dilute. Or they're just cruddy. Could be either of those.
Probably a little heavier on the latter than the former, but yeah.
Probably both. Yeah, for sure. But this guy probably, either is an ex-employee or is an investor or has something going on, owns a ton of stock, a ton of underlying at a relatively inexpensive level. He saw his $1.7 million he had invested in this stock turn into $3.2 million in a couple of days. And he wants to protect his assets. And he probably is talking to somebody that maybe doesn't, you never know who the advisor is or exactly what his axe grind or what type of restrictions he has on his ability to sell, So that's kind of what I would bet if I, just kind of looking at this stuff.
Yeah, this one.
Yeah, because you're right. That is a lot of premium.
Yeah.
This guy really took the hard road to construct this one. But I think that makes sense with some of the definitely the only way I can see this playing out is a guy who's got an axe to grind and has a ton of underlying.
Well, what kind of volume does the stock have?
Yeah, it's pretty light as well, I'd imagine. Let me pull it up here.
It's under 1 million. It's under 1 million shares a day typically. Although it's been heavier. It's heavier on these since it's picked up. It popped up. It's been more like 1.5 million.
It averages like 1.6, and lately it's did about almost 4 today. But typically it's well below. I would say around 1 million or lower. So this guy he might want to look for some liquidity in the options as well.
Yeah, it may be a backdoor way. It may be a backdoor way of him making sure he gets to dump his stock at certain levels.
Yeah, that's why we like pulling up ones like this, just because these are the definitions of odd.
They are. It's the odd block.
Perfect ones for the odd block. And we'll close up today with Brocade. I know that one's been kind of moving all over the place lately. It has seemed like had like about a 10% or so swing in the last couple of sessions, with some serious movement. Let's see, where did it close today? It closed at around 604, down 3.5% today after rallying yesterday. And I think Mark, you've been following this one quite a bit, so I'll let you run with it. But this one's definitely had some interesting movements over the past couple of sessions.
Oh yeah, we've seen open interest on this stock just open interest and trading in the stock just absolutely explode. The stock went from it always traded some, but it was like a $4 or $5 stock, so it traded along one line where people are betting at the money, and a few thousand. What was the average volume? Do you have a way you can look at the average volume 2 weeks ago as opposed to what it is right now?
Not without firing up a couple things that might hurt the old Skype.
Right. But generally speaking, the average volume has been, and this is including the last 2 weeks, the average volume was about 22,000 calls. Okay. Today we saw 66,000. Yesterday, I think we saw well over I want to say close to 200,000. The open interest on the October 6 line, puts and calls, has ballooned to over 210,000. There's another 150 on the 7s, another 100,000 on the OC5s. This is all October. There's tons of chatter, just massive chatter about IBM possibly having a bid in at $7.50, and that Dell is it may eclipse that. Again, total chatter, nothing confirmed, but kind of what I've heard from a couple of different places that they've been talking about. And if that's the chatter, and if that something like that leaks, even if even if they don't get bought out in October, we could see the October 7s that you could buy for 10 cents. You buy the October 7s for 10 cents, okay? If we're trading $7.50, in a couple of days, those 10-cent options are quickly going to be worth, they're going to worth 4, 5, 6, 7 times what they're currently trading. It's a quick way to make some very easy money.
Yeah, you have an axe to grind in this one. Yeah, you definitely do. And it would, the rumors swirling around this would make sense. I mean, Dell has been on a bit of an acquisition tear lately. They had that big bidding war for, I believe it was 3PAR with HP a few weeks ago.
It was. And they may be smarting from that one and want to do something.
So yeah, something a little better, because they had a nice back and forth with HP over that one, and then so maybe Brocade is the next target in their sights, in which case these OX7 lottery tickets could pay off nicely.
Absolutely. Now, there's going to be a lot of people that are going to be thinking to sell puts. When after a stock like this has made kind of initial run up like this, I'm never a huge fan of selling puts because you kind of missed out on the opportunity to get a lot of that put selling premium. And if it turns out that this rumor is bogus and they say, okay, and nothing comes of it, in 2 weeks Brocade's going to be back at $4.50, and the 30 cents that you collected for the October 5 puts, actually the October 6 puts, the 28 cents you collected for them, it's going to be $2.50 in your face, and you're not going to feel so happy about collecting that. And with the prices as inexpensive they are for a $6 stock that's going to get bought for $8, if you want to make a cheap bet, buy the 7/8 call spread for a nickel. That is the classic cheap bet. You buy the 7/8 call spread for a nickel 100 times. You spend $500 on it, plus your commission, which in some cases would be almost as much as the purchase itself.
I was going to say, depending where you put that on, that could be costly.
If you do, Options Express if you use Options Express and you start putting in some big orders, doesn't Options Express have some ways of not running this up and up and up and up? Can't you kind of get some sort of flat fee on these type of things if you like it?
Yeah, and if somebody's going to put in this trade and they do ask for, an accommodation on the commission, that's definitely something we would think about, and most times that is going to get done.
Yeah, there you go. So you work with a smart firm with traders like with Tim, then you can put on this bet and not get absolutely eaten alive by commission. And then, Brocade, okay, IBM is bidding $7.50. The 5 cents is now 60 cents, 70 cents, and you've made 1,200% on your Brocade call spread. And that is actually, in my opinion, kind of a better trade than straight up buying the 7 calls. I know 12 cents, 13 cents sounds cheap, but kind of taking advantage of that little of the 8s can really work for you. So, or even the 9s for 4 cents,
I tend to agree with kind of missed your chance to hit the puts here. I mean, if you hit these OX7s for $1, I mean, these are already in the money these are actually $1 in the money already. So you have to hit these OX6s for 30 cents. That's a lot of risk to be taken on, unless you really want to own Brocade at 6 or 570.
Yeah.
That's probably not the way I would go after this one.
Yeah, when it was trading around $5 and that rumor came out, if you were smart enough to sell like a risk reversal where you sell put by call, you're sitting pretty. Otherwise, you're I would stick to kind of some of the call buying speculative stuff. There's no reason to turn a spec bet into a huge loser. All right, and based on the volume, you've got to think something's going to be said here. I mean, have you ever seen volume like this in a stock and then just absolutely no news comes out?
It would be unusual.
I mean, that would be the odd block if all this volume happened and nothing came out.
There's a ton of smoke here. I mean, I'm choking on smoke. I'm looking to see if I see any fire yet, but the smoke is effusive, to say the least. But what about you, Mike? How would you play this rumor here coming up in Brocade?
If I was looking at it, and like I said, just full disclosure, we don't have any clients in Brocade, either long or short, in our managed side of it. But the other thing that I would consider doing is something along the lines of possibly buying the 8 calls and then doing it in such a way to where we get in, it would have to be with a very, 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 hopefully I said very enough times, small section of the portfolio, a very small section of it, and then just with the intention of, if we get a little bit of a pop in it, as soon as the 7 cents that you pay for those calls goes to 14 cents, if it were to go up to 7, that's when we would get out and then just basically ride the lottery ticket from there, so to speak. I mean, that's the only other way that I would see doing it. Or you could do a similar concept with the spread, like what Mark was talking about, but just with the intention of getting out.
When you say get out of it, you mean dump half of it, and then
I'm sorry. I misspoke. Dump half of it. Yes.
Yeah, I love that type of bet when you can basically work a trade into, from the onset of the trade, you can't lose, you can't really go negative. I love that kind of trade.
It is, and then the other thing that I was thinking about too, possibly this would, because it's such a smaller amount of money, you could actually do a leg in to where you're buying the 7 calls at 13 cents, and then once that 8 call goes up a little bit, leg into the bull call spread, and so that way you basically have a free ride from 7 to 8. The only problem is that if it doesn't go up, then you're out everything. So that's kind of what the perspective you have to take on it.
Yeah, working those hard leg first spreads are always fun. But yeah, I like the idea too of riding some of the calls up a bit and then dumping off enough to cover your costs and then just taking the rest as another free lottery ticket in your pocket. All right, so now we'll dive into the spread block.
The Spread Block, brought to you by Options Express. Options Express lets you trade futures and now foreign futures too, where and when you want. From advanced charting and free daily trading ideas to automated systems trading and free educational resources, Options Express is the online broker for all traders. Visit optionsexpress.com to open your free account. Futures involve substantial risk and are not appropriate for all investors. Please read this disclosure statement for futures and options available at optionsexpress.com/futures risk or by calling 1-888-280-8020 prior to applying for an account. Options Express is a member of FINRA, SIPC, and NFA.
Welcome to the Spread Block. This is the segment of the show where we break down some interesting activity that's going on at Options Express, as well as some of their insights into what their customers are up to and what they're seeing in the market right now. And so we're going to hand this one over to Tim. So Tim, what are you guys seeing over at Options Express these days?
What I'm seeing today specifically is a rolling of the weeklies. They're doing this on spread orders, and they're essentially, getting out of the weekly trade that is going to be expiring tomorrow. The stock indexes such as the RUT, the SPX, and the NDX, and then they're moving into the next week. But like I was saying before, they're also doing that with some of the individual stock options. One thing that we have here that I really like at Options Express is that when you are at our option chain page, we are constantly updating the list of what options are available for those weekly options, because they are changing all the time. We've had some confusion over the past couple weeks of, is this option available for the weekly, or was last week, it's not available this week. So today is the day that we see a lot of weekly option trading. In addition to weekly option trading, we're also seeing a lot of people trading the metals. There's a couple different ways to trade the metals. One of the reasons why I like being at Options Express is because you can trade the metals via the futures, large size and minis. The options on the futures, those are only available on the large size contracts. And then you can also trade them via the ETFs. So that's, again, one of the more popular trades that, we're seeing. Mostly people, I would say that all over the board on this one. We have a number of people selling call spreads. We have people selling puts. We have people buying calls. And then buying puts. So, that's really some of the more popular trades here over the last week, last couple of days anyways, about what's going on here at Options Express.
You mentioned the weeklies, and we've seen a lot of this on our site as well, where people were initially confused about what they were doing, how these things were being listed. Did they have a multiplier? I think what the CBOE did, which was interesting and also caused some confusion at the same point, was when they started adding and then removing names every week through the earnings cycle, which was fantastic because that really is the way these kind of instruments should be played, is they're perfect earnings instruments. But on the flip side, when you have an option that's listed one week and then is delisted the next, you have a lot of people scratching their heads out there as, what the heck are they listing out here? And is my thing a weekly this week or not? So do you guys do a lot of updates with that on the site?
As far as the upcoming weeklies, we don't have that. I mean, we don't know what they're thinking about putting out there. But we do have, what is available today to trade. Because it's, a newer product and because of some of the confusion that had happened before, I mean, the weeklies are looked at, very heavily early in the morning by, different teams to make sure that they're being quoted correctly, that the, orders are going in correctly. But we do have a list. We do have a list on our option chain page that says, you can now trade options that expire weekly and, click here for the list. So, that's a great resource because I do get a lot of people who do call and they'll say, is it weekly available on this or is it weekly available on that? One of the other things that I wanted to mention too that I do see a lot, a lot of times people are using these weeklies where they're going out and they're buying the leap and, they are just constantly selling the weekly in front of it. That's one of the more popular trades as well.
That was going to be my next question, actually, is what are you seeing, what's the most popular usage from the OX customer on these things? Are they coming in and just using them to kind of, whack out some premium ahead of earnings? Are they looking to really just use them for some, buying calls to spec? What is the primary function your customers are using the weeklies for? Is it primarily premium selling, would you say?
Yeah, that's a real good question. They are being used primarily for premium selling. I haven't seen, if any, too much, just outright buying of calls and puts on these. Sometimes people try to get creative with, vertical spreads, and, they can be successful at those. But they have to be quick. They have to know what price they want to sell it at. They have to have some real good analysis of the stock. Without that, this is it's a very difficult instrument to trade.
In a product like this where it's essentially expiration week every week, I'd imagine it has made life for guys like you and John over there a little bit more hectic. So I'd imagine your call volume has increased somewhat since these products have emerged on the horizon.
Yeah, it has. And, again, like I discussed earlier this week, or maybe it was last week, about the care that it takes on expiration Friday. I mean, now we have one every single Friday. So, again, it's you really need to pay attention on expiration Friday, and with weeklies, you need to pay attention even more. So yeah, it is making things busy for us.
Just wait till they add the dailies, then your life will improve exponentially.
Right.
Well, I think that's pretty much all we have for the spread block / the express block this week. But unless you guys have anything else to add, we will dive right into the strategy block.
The strategy block.
And welcome to the strategy block. This is the segment of the show that Mark likes to call Tusaw's 2 cents. I think that's a good name for it.
I love that. It reminds me of like Jerry Springer's closing thought, you know? It's like,
There you go. And if I talk long, we'll call it my 3 cents.
So, this is the segment of the show where we discuss some interesting strategies that we feel are relevant or particularly interesting given what's going on in the market right now. And Mike, what do you have on the docket for us today?
Right now, we do a lot. I Know Your Options. We do a lot with hedging the long-term portfolio. And what we're looking at right now, today, we had a down market, and we're not necessarily at a point to where we're ready to take action as of yet with a lot of our clients and with a lot of our hedges, so to speak. But we're to the point now to where, should the market continue to go down, we have to answer some questions. Now, let me set the table for this first. What I'm referring to today is a stock with a protective put or a collar strategy. Now, a stock with a protective put is fairly simple. You own XYZ stock, you buy a put option to protect the downside risk, so to speak, from the stock. Now, the advantage of that is if the stock goes bankrupt, you have insurance, but the disadvantage is that puts are not free. The other strategy with which this can be relevant, I should say, is to that of a collar. That is a strategy with which you sell an out-of-the-money covered call, and with the premium you collect from the covered call, you use it to finance the insurance cost of the put. So right now, what I want to go through today are some choices with which you have when the stock that you own is going lower in value and you're seeing the stock going down, but the value of the put going up at the same time. Now, it's pretty easy to just say, okay, just buy puts, then you're hedged. Well, that's no fun. That's much too simple, and it's not always the right thing to do. So in looking at this, whenever we have stocks that go down in value and we have our protection in place, we have some choices as to what to do with the protective put. Choice one, we can do nothing. We can just say, you know what, we're still a little bit concerned with the stock going down in value a little bit more, and because of our concern, we want to remain in the put option. We want to continue to have the insurance in place, because if this stock continues to go down, we want to be able to look our clients in the eye and say it's mathematically impossible for you to lose any more than X amount. So that's one choice, and that's doing absolutely nothing. Now, another choice with what you can do, and this is when you're deciding to get a little bit more active with your hedges. Let's say that the stocks come down a little bit, and you're looking at it, and you're thinking, well, you know what? I think that this downward move that we've had, I think we're towards the end of it, or I think we're getting really close to a reversal, but I'm not ready to give up all my protection as of yet. What I can do is I can take profits on my puts, and with some of the profits, I can buy a put at a lower strike price to where I'll still have downside protection. But ultimately, remember, you don't want to overhedge yourself, because of the fact that if you're in this stock to begin with, you're looking for the stock to go up. And if you overhedge yourself, it just becomes an overpriced money market account, basically. So now another thing with which you can do, let's say that you've made a nice little profit on the put, and you have good reason to believe that the stock is going up and you want to be bullish in the near term, you can actually just sell the put option and take profits on it, and you're now bullish on the stock. Now, by doing that, that's kind of a way, it's kind of like a reverse way, a premium buyer's way of an income strategy on a stock, so to speak. When the stock takes a dip, you profit on your puts, pocket the premium, and then you ride the stock out to the upside. Now, of course, the disadvantage to that is that you have no hedge to the stock, and it could continue to go lower. So that's the decision with which you might face. Now, the final way with which you can do this, and this would be if you're pretty aggressive to begin with, and you're very long-term in your view on the stock. Stock goes down in value, sell the puts for a profit. With the profits that you make on the puts, you can buy more shares of stock. Now, by doing that, that's going to lower the cost basis of the stock. It's kind of like the way with which I refer to it in my book. We've probably heard of the concept of dollar cost averaging, to where when the market, you just continually buy into the market, into your retirement account or whatever the case may be. When the market's higher, you're benefiting from your current shares increasing. When the market goes lower, you can buy more shares. By selling the puts for a profit and then buying more shares when it's lower, that's kind of our way of dollar cost averaging, but letting the market pay for it. once again, you have to have a long-term bullish view on it, but nonetheless, you do have choices when you're doing things like this. And the beautiful thing about options is that you can customize your own portfolio, your own risk, and you can put yourself in situations like that to where you're not just throwing the dice and thinking, okay, if the stock goes down 50%, what's the old saying? When in danger or in doubt, run in circles, scream and shout. You actually have a plan for it.
We used to say on the floor, just when in doubt, palms out. But hey, Mike, I'm curious how you guys are structuring some of your stuff over at Know Your Options, because there's a lot of debate about the optimal month and time frame to use for these hedging protective puts. So when you have a customer who comes in or a client and they're long a lot of equities, I imagine you're not hedging with front month puts unless you're really looking at some near term stuff because you're taking a big decay hit. So what do you guys normally look in when you're looking at downside puts for hedging? You going like 3 months out, 6 months? Do you go into the leaps? What is the Know Your Options Inc. recommendation?
Well, typically we do yes, no, and maybe on those questions. We have a couple ways with which we look at it. For equities that tend to move a lot, I'm not able to really mention any specific names, but if it's a high flying stock, so to speak, we wouldn't have a problem going front month. However, we would probably use a collar in that case, to where we would finance the protective put with a covered call. So if that were the case, because we have a lot of clients with which we're getting more and more one-off style clients to where they'll say, I got all this stock because I used to work for this company. My cost basis is next to nothing. Don't get called out, but I want to protect it in case it goes down. So we get a lot of clients like that. And so in the stock evaluation, we'll look at that first. On the general market as a whole, if we're looking to invest in the market for the long term for clients, a lot of things with which we'll kind of do the non-levered diagonal spread, so to speak, and that we will use further out puts to hedge, but we'll try and finance it with near-term call options in one way or another. So we do a little bit of everything with it. It just depends on the client and the situation.
I like the mention of collars. I think we can do a whole separate segment just on collars and some of the different ways to structure them and the optimal ways to use them.
There are about 1,000 different ways. Everybody has their own little twist on it.
Exactly. And there was a great study the OIC just did recently on collars and how they compared collars on the NASDAQ versus owning the underlying outright. But that is definitely
the cube.
Isn't that a big piece of one of my favorite option trading books, Go Long?
Yes, that's a good book. I've heard of that one.
You may have.
Available in bookstores everywhere, by the way.
I was just going to ask you, where can someone pick that up if they wanted to pick up your book? I realize we haven't given you a plug yet, so go ahead.
We do have a Go Long new option strategies for buy and hold investors available in bookstores everywhere.
Can they get it on Amazon too and on knowyouroptionsinc.com?
They can get it on Amazon, but we're not actively promoting the book. We're trying to keep our focus on managing money for people in the best way that we can. So you can actually go to our website and you can get a free chapter, knowyouroptionsinc.com, but we don't sell the book directly. We're trying to just focus on the money managing as best we can.
That's going to close out the strategy block for this week, and now we're going to move on into Around the Block.
Around the Block.
Welcome to the Around the Block segment. This is the segment where we discuss what's on the calendar for the next few days going into the weekend. So who wants to dive in first?
Well, we got, I think tomorrow, durable goods orders, I think is actually going to be somewhat of a driver tomorrow. Durable goods, ex-transpo, and maybe new home sales. Home sales have been kind of home sales. Building permits, the whole thing has been surprising all week. Can they make it, 3 reports out of 3 reports with new home sales tomorrow at 10 a.m. Eastern time? And then we also have durable goods tomorrow. I think both of those are going to be drivers of the marketplace. Leading into next week, Consumer confidence is going to be huge on the 28th. And, initial jobless claims everybody loves: Chicago PMI, personal income, auto sales, truck sales, construction spending, all great things people are going to be paying attention to. Also pay attention to kind of where the volatility is hanging out. We are right at about normal levels, okay? So anywhere we go from here, all right, is saying something. If we go much higher, we're starting to get a little elevated. We go much lower, we're starting to get cheap. This is the vanilla ice cream with nothing on the side of volatility right now.
So how is this? Is this just by the historical averages? Is that what you're going by?
Well, historically we're still a little high, but if you go kind of over the last 2-3 years, I think we're settling in, at least for the short term, in and around 24%. Historically, it's more like 20 over the entire life of options. But for kind of where we've been, where the economy is, historically, I think we're right about there. We should be a little bit elevated just with what's going on around us. And I think if you compare similar times, 82 or 2002, that's kind of where we're at right now.
Yeah, the frame of reference for vol definitely has changed since 08, 09. I mean, before that it was, we were hanging out in the mid to high teens for most of that in the VIX. And then, and the upside was considered, you never get past 45 in the VIX. And then, we proved that wrong quite substantially a couple years ago. So, the frame of reference now is definitely, definitely changed.
Traders said to the VIX, essentially, no man can eat 50 hard-boiled eggs. And the VIX said, oh, yeah?
The VIX ate 80 of them.
All right. By the way, email Option Insider this week. If you can name what movie that came from, I will send you the latest issue of expiring monthly, the Option Traders Journal, FOC, free of charge.
We'll get the forum active. People can also post their answers in there for the Option Block forum. We've been dragging our feet with a few other projects before getting that up and running, but that will be up and running soon, and you can post on that. You can also use the contact form on our website. We have Twitter, Twitter/Option Block, as well as the Google Voice number, which I don't know off the top of my head, but our announcer will say on the closing of the show, so stay tuned for the outro if you want to hear the Google Voice number to leave your question.
There you go.
And with that, we will bring to a close this session of the Option Block. And stay tuned, because we'll be putting these shows out on a bi-weekly basis going forward. Forward to every Tuesday and Friday seems to be our schedule for releases, and so we hope to be able to stick to that. We're glad you guys like it, and glad you guys are downloading it out there on our feed and in iTunes and on the Options Insider. And it's going to be in more places and in more areas to find very soon. So thanks again for listening to the Option Block, and we'll see you again next week.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting, and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved.